The day trader, the sprinter of the investing world. Day traders buy and sell stocks within the same day, sometimes within minutes. This strategy exploded in popularity with the rise of online brokerages and real-time data in the late 1990s. Think high screens, high caffeine, high volatility. Day traders target micro-price movements, relying on technical analysis and market momentum. The tactic is speed and precision. Enter fast, exit faster. Revenue comes from capital gains, if you're right. But studies show 80 to 97% of day traders lose money over time. Still, the allure of fast profits keeps this strategy alive. Day trading reflects the human tendency to seek immediate reward, even at high risk. The value investor, made famous by Warren Buffett, but rooted in the teachings of Benjamin Graham. Value investors look for stocks trading below their intrinsic worth, often in boring or beaten-down industries. This approach took off after the Great Depression, when investors sought safety and logic. They target businesses with strong fundamentals, ignored by the hype cycle. The strategy is patience and discipline. Buy undervalued assets. Wait for the market to catch up. Returns compound over years, not days. The value investor shaped the idea that investing is more about temperament than intellect. Success favors those who can wait. The growth investor, the optimist with a calculator. Growth investors focus on companies that are expanding quickly. Think tech, biotech, and emerging markets. This style became dominant in the 2010s as low interest rates and innovation rewarded risk-taking. They target companies reinvesting profits into scale, not dividends. The tactic is future focus. Overpay today for big gains tomorrow. Revenue comes from appreciation, not cash flow. Amazon, Tesla, and Nvidia were growth investor darlings. This style shaped the modern market's obsession with disruption, where earnings don't matter until they do. The index investor, the passive powerhouse, popularized by Jack Bogle and the invention of the index fund. This approach says, don't beat the market, own it. Index investors buy entire markets, like the S&P 500, through low-cost ETFs or mutual funds. The strategy is simplicity and scale. Minimize fees, maximize diversification, ride the long-term trend. They target the average investor who values peace of mind over performance chasing. By 2023, passive funds held over $13.5 trillion, surpassing active funds for the first time across all asset classes. The index investor democratized access to wealth creation and turned boring into brilliance. The dividend investor, the income earner. Dividend investors seek stocks that pay regular cash distributions, usually from stable, mature companies. This strategy became popular with retirees and institutions seeking predictable yield. They target businesses with strong balance sheets and a history of payout consistency. The tactic is cash flow over capital gains. Get paid to wait. Telecom, utilities, and consumer staples are common picks. In a low-interest rate world, dividend investing became a substitute for bonds. This investor shaped the belief that investing isn't just about wealth growth, it's about financial independence through income. The crypto investor, the digital frontier explorer. Crypto investors bet on blockchain-based assets like Bitcoin and Ethereum. This category exploded post-2017, fueled by distrust of fiat systems and belief in decentralized technology. They target coins, tokens, and protocols with massive upside and massive risk. The strategy is asymmetric bets. Risk $100 to make $10,000. Revenue comes from speculation, staking, or arbitrage. Crypto investors embrace volatility as part of the game. This group reshaped the definition of what counts as money and revealed that speculation is timeless, even in new forms. The angel investor, the early believer. Angel investors fund startups before they're proven, often before there's even a product. This model surged with the dot-com boom in the 1990s and the rise of Silicon Valley startup culture. They target founders with vision, grit, and pitch decks. The approach is risk capital. Write small checks, hope for unicorns. Returns are binary. 90% of startups fail, but the 10% that win can return 100x. Angels shaped the innovation economy and gave rise to the idea that capital, not just code, can change the world. The real estate investor, the land and leverage lover. Real estate investors buy properties to generate rental income or flip for profit. This strategy has existed for centuries, but exploded post-World War II with suburban expansion and favorable tax laws. They target undervalued neighborhoods, distressed assets, or high-yield areas. The tactic is leverage. Use debt to magnify returns. Revenue comes from rent, appreciation, and tax advantages. The real estate investor created the American dream of wealth through property and turned location into a legacy. The quant investor, the math nerd with money. Quantitative investors use algorithms, models, and big data to identify trading opportunities. This model took off with computing power in the 1980s and now dominates Wall Street. They target inefficiencies invisible to the human eye. The strategy is statistical edge. Find repeatable patterns. Exploit them fast. Revenue comes from small but consistent wins at massive scale. Renaissance Technologies and Citadel are legends in this space. Quants changed the game. Investing became less about gut, more about code. The ESG investor, the mission-driven capitalist. ESG investors allocate capital based on environmental, social, and governance criteria. This model rose in the 2010s alongside climate awareness and social justice movements. They target companies with ethical practices and long-term sustainability. The strategy is values over velocity. Accept lower short-term returns for higher moral alignment. Revenue comes from market gains, but also from impact. ESG investing reshaped the narrative that money and meaning must be separate and gave investors a way to vote with their wallets.